Okay, when we first learn accounting, we talk about selling services. And now we're going to start talking about selling things instead of just services. All our rules about the accounting cycle, particularly the journal entries, are going to be exactly the same. So whether you think about the 6 rules, or maybe you think about the accounting equation and the books presentation, or maybe you think about my little chart, the rules are going to be the same. What's going to change is we're going to have a new expense account called cost of goods sold, our cost of the goods that we just sold, and we're going to have a new asset account called inventory. So let's keep the numbers nice and simple. Before this, we had the single step income statement, our revenue minus our expenses to give us our net income. And the journal entry, whenever we provided service revenue, was to debit cash or accounts receivable and credit service revenue. Service revenue keeps track of our sales, whether we get paid today, tomorrow, or never. Well, now we're going to have a new expense account called our cost of the goods that we just sold. And it's so important that we're going to subtract it first and strike a subtotal called gross profit before we go any further. Then we're going to subtract operating expenses. That's the stuff that happens in the usual course of our core business. And that's going to give us, the book calls it net income, but we're going to call it operating income for right now. So in a vertical format, that's sales minus our cost of the goods we just sold gives us our gross profit. Gross profit minus selling, general, and administrative expenses or operating expenses, things like rent on our stores, like salaries to our employees, gives us our operating income. And let's start abbreviating our cost of the goods that we just sold to be cost of goods sold. And then gross profit divided by sales is going to be gross profit margin. That's the markup. For example, if you think of Costco, you think of low prices, and sure enough, their gross profit margin is about 12%. You think of Whole Foods, you think of high prices, and their gross profit margin is over 30%. So they mark up their goods a lot more. So this is kind of the heart of our new multi-step income statement. These 5 lines: sales minus cost of goods sold gives us gross profit, minus selling, general, and administrative expenses gives us operating income. We're going to add some stuff at the top, we're going to add some stuff at the bottom, but for right now, this is a good thing to really focus on. This is the heart of our new multi-step income statement. And what do the journal entries look like? Well, let's say I have a corner market and I want to sell a bottle of bleach. Before I can sell that bottle of bleach, I have to buy that bottle of bleach and put it into inventory. Let's pretend like Clorox charges me 90 cents for that bottle of bleach. And since we're just learning this stuff, let's use simple journal entries and let's talk about cash transactions only. Inventory is an asset. Assets increase with debits, so we debit inventory for 90 cents. We pay cash for it. Cash is an asset. It increases with debits, so it decreases with credits, so we credit cash for 90 cents. And so now that bottle of bleach is sitting in my inventory for 90 cents. How much am I going to sell it for? More than 90 cents. That's my gross profit margin. That's my markup. So a customer comes into my store and buys that bottle of bleach. She pays me $1 cash. I debit cash for $1. Cash is an asset. It increases with debits. And sales is what we're going to call our revenue account now. Sales is a revenue account, so it increases with credits. I put the balance sheet accounts in black font and the income statement accounts in red font. Now, if we're in the perpetual inventory system, we're also going to perpetually update our inventory account. Well, what happened to inventory? It went down by 90 cents. And we sold that bottle of bleach. Inventory is an asset. It increases with debits and decreases with credits. That bottle of bleach was on our inventory for a 90-cent debit, so let's get rid of it with a 90-cent credit. And let's debit cost of goods sold. Cost of goods sold is an expense. Expense to debits, expense to debits, expense to debits. So now we have a 90-cent expense. We've got revenue of $1, cost of goods sold of 90 cents, so we've got gross profit of 10 cents or 10%. 10 cents divided by $1 is 10%. That's all there is to it, but we're going to have some nuances down here. If we have other revenue and gains, suppose we earn interest income in our bank account. Well, that's not part of our business, so it's not part of our operations, so we'll break it out separately. Other expenses and losses. Suppose we have some interest expense, or suppose we sell an old piece of equipment at a loss. That's not part of our day-to-day operations. That's not part of our core business, so we'll break that out down here separately. And then there's some complications above the net sales line. We're going to have sales returns and allowances. Those are our dissatisfied customers. So if somebody returns us merchandise, we'll book it as a sale return and allowance. If we have to reduce somebody's bill to keep them happy, we'll book that in sales returns and allowances. Sales discounts keeps track of customers that pay us early. We want our customers to pay us quickly, so if we send them out an invoice, it might have terms like 2, 10, net 30. That means if you pay us within 10 days, you can take a 2% discount. If you don't pay us within that 10 days, you still owe us the net amount after 30. So we'll keep track of that here. We want to know what our dissatisfied customers are. We want to know which customers are paying us early. And when we take our gross sales minus our dissatisfied customers minus the discounts that our customers take for paying us early, we end up with an account called net sales. But big picture, this is the heart of our new multi-step income statement. Sales minus cost of goods sold gives us a gross profit, minus SG&A gives us operating income. And when we read about it in our accounting class, our textbook will often, instead of having cash sales, talk about accounts receivable. And when we buy inventory, we won't pay cash for it, we'll be using accounts payable. But that shouldn't confuse us too much because all our rules about debits and credits stay the same. And in the perpetual inventory system, we're going to have 2 journal entries, one to book the sale and one to update our inventory. And if we remember that our sales account keeps track of our sales, whether we get paid today, tomorrow, or never. And if we remember that cost of goods sold is an expense account and expenses or debits, expenses or debits, expenses or debits, it shouldn't have any problems. All right, I hope that helps. Hey, can somebody clean up this bleach that's on my screen? Thanks.